Hello, everyone, and welcome to our INDEP online event with Janina Urban and Solveig Degen, who plans the future, democratizing investment in a financialized economy. Investment is a form of planning. It brings into existence what currently does not yet exist. Today, large-scale investment decisions are largely made either by states or by actors in the financial sector. But can finance, one of the central nodal points of contemporary capitalism, be transformed into a tool for democratically shaping the future? In this talk, Janina Urban from the University of Witten-Herdecke and Solveig Degen from the Humboldt University Berlin explore the principles that currently structure financial investment and the profound challenges these logics pose for social and ecological relations. Building on this diagnosis, they examine how investment could be reorganized along democratic lines. They will discuss both historical and contemporary initiatives aimed at socializing investment and introduce two prominent approaches within current debates on democratic economic planning. Finally, the talk reflects on the political and practical limits of such projects, given that the financial system is often perceived as the domain of experts rather than an arena of democratic for democratic contestation. I'm sorry. And real quick, Solveig Degen is a doctoral candidate in the research project Socialization in Theory and Practice, which is based at the Center for Social Critique in Berlin. Real quick, we also have the link for that. Here it is in the chat. And the project is funded by the Gerda Henkel Foundation. In her research, she combines approaches from political economy and sociology with perspectives from political theory and critical social philosophy. Previously, she worked at the Institute for Spatial and Social Ecological Transformations at the Vienna University of Economics and Business, where she has also completed her master's degree in social ecological economics and policy. And Janina Urban is a PhD student and research associate at the University of Witten-Herdecke at the Heisenberg Professorship for Politics, Transformation and Sustainability. Her research revolves around the political economy of sustainable finance, monetary policy, banking regulation, economic planning approaches, and pluralist economics, especially Keynesian economics. Both of them are also part of the German Network for Democratic Economic Planning, and Janina also co-authored a report called Financing the Green Transition, which you can find here in the chat. Okay, then the floor is yours, Janina and Solveig. Take it away.
Yeah, thank you, Eric, for the very nice introduction, and also for inviting us to give this talk here. Janina, perfect, you sharing the presentation. Yeah, before we start, we just thought we'd give you a little bit background information of on this, how we came up with this talk or why we're talking here today. So Janina and I prepared this presentation initially for a little conference we had with the German Network for Democratic Economic Planning, and the theme of the conference was what are feasible transformation policies for initiating democratic economic planning, and our topic was socializing investment. So Eric asked us to give this talk again in this context to a broader international audience. So that's what you're going to hear today. So just a little heads up, it's not neither my dissertation topic nor Janina's, but we've both read a lot about socializing investment and dealt with these topics. And this presentation is kind of a distillation of our work on this topic.
Great. So I will take over. So today we are going to talk about 45 minutes and have envisioned this structure here. So we're going to have a very brief introduction, why to understand finance as a form of planning, and then to ask how finance actually currently plans or make decisions, and how already, as Solveig said, how transformation path could be created in current system, and then also pointing towards broader transformation strategies. And then we have more concrete examples, historical examples, as well as kind of schematic examples of how to socialize investments, which Solveig will present. Yes, so maybe you're familiar with this article by J.W. Mason, who talked about socializing finance, and I think makes these these two very convincing points. So the question is, what makes the financial sector a planning actor? And the answer he provides in this article in the Jacobin magazine is that profits from the social surplus do not remain within individual firms, but are pooled by financial or in financial institutions. So this can already be regarded as a step of socialization that takes place. But then the question becomes how this socialized social surplus is then redistributed. And here Mason differentiates or introduces how this planning currently takes place, and why it's also helpful to differentiate between the, let's say, productive economy and the financial economy. So productive firm realize profits on past productions, whereas the financial sector operates based on expectation on future economic development. Right, so as Eric said in the introduction, it's about the question of bringing something into existence that does currently not exist. And I started this presentation in the workshop by putting on the one hand this Keynesian perspective that or this kind of division among Keynesians, that they have always very much paid attention to monetary and financial phenomena, and the criticism that then Marxists brought to it, that actually they thought that actually enterprise leads and finance follows. And this perspective, I think, by Mason is kind of an interesting update to this very long clinch between Keynesian and a Marxist perspective, but that, as a side note. So also when we previously gave that talk, we very quickly jumped into problematizing or sketching out some different transformation paths. And for this, I've decided to go a bit a step back to shortly give a glimpse of what the financial sector is made of what money and credit is made of. And maybe, and the most helpful depiction I find is to regard or to view the financial or finance as a very hierarchical system, and which is composed of different layers with different institutions, but with a lot of promises to pay, which is the definition of credit. So one can imagine the financial sector as this layered and very hierarchical system, and with this concept of the money fetish, Kapadia here describes that at the lower level things appear as money, which are actually a form of credit. And the higher we move up, we come to the very top of the monetary hierarchy, which then is the most high-powered form of money, which is currently the US dollar. So this is just to make very clear that finance is hierarchical, and that it's very important to differentiate between our common understanding that we have in everyday life and that appeals to people is very different from what a theoretical account of money and credit is. This is basically the main gist of this explanation here. And maybe another interesting aspect that this kind of pyramid is supposed to convey to you is that the system is also flexible. So at times it can allow a very much expansion of credit. So this is the banking sector that allows the creation of credit with the speculation towards something coming to existence in the future, but then also the pyramid then shrinks at a certain point, and the so-called money constraint then comes in, and it has to be different promises that have been made will either be paid back or not. So this is another element of the monetary system. Another very awesome thing that you're probably aware of, but finance is highly globalized. Just as a depiction here on the left-hand side, the cross-border claims among different countries, but I will come back to why this is important. So if we look at this, and so I already said that we talk about finance as kind of a node in globalized capitalism, and here always the questions, okay, why can it be or should it be an anchor or a starting point for socialization? So it is, or I think the awareness of the problems this hierarchical system is producing is kind of increasing a lot. The topic that the US is still having this great hegemony in the monetary and financial system, but that is risking of losing it maybe around. But also there is the topic that actually a lot of countries, or all countries that are not the US, are financially constrained or financially subordinate, which actually also applies to the European Union with the effect of the disciplining of fiscal policies, so the cutting of budgets and other things that are related to this, like housing speculation due to the safe asset character of real estate. I won't go into detail in this, but I will make two examples of how finance currently decides on to build the foundation to say what would have to be done to actually socialize finance. So the two examples I want to bring is one more recent one, which is a topic of so-called debanking. And then I will go into the question of what I call the investment into planetary destruction. You could also, the policy report, you could frame it a bit more positive, but this investment into planetary destruction is a bit more what is currently taking place, but there have also been other times. So finance is also a bit flexible in that regard. So I will give you an example or introduce you a bit into the nitty-gritty of how finance currently decides with the help of this example. So there was the US government declared the anti-fascist group Antifa-Ost as a terrorist organization at the end of the last year. And the reaction to that was that the German socio-ecological bank, GLS Bank, terminated accounts of the Red Help or Rote Hilfe, a German communist party, and anarchist Black Cross Dresden. So this was interpreted as like a strongly or an increasingly politicized financial system in which the dominating or the hierarchical power of the US was playing out on the grounds in Germany. And a very interesting article that I can also link to you later made an analysis of if that was a directed attack, so to say, against those groups that are very important for the German left infrastructure. But what turned out was more the case is that it was due to risk management. So understanding finance or financial actors, let's say simplified way, banks, as actors that are risk managers. So what they did was actually they were preemptively trying to reduce their risk by cutting ties to those organizations. As they are part of international agreements that are part of anti-money laundering and terrorist financing, regulations that are in place since 9/11 and the financial crisis, they were expecting that they might be penalized by these international agreements. They argued that they might be excluded from an international infrastructure, SWIFT, and this was the reason, which actually is could be the case, why they closed those accounts from these closed this account of those different groups. So what I want to kind of point out here is that we have both things happening at the same time. So we have this hierarchical structure on the one hand playing out, and a very indirect form of where a certain behavior can be classified as risk. So this is something that we on the left could be looking out for of the actual decisions that the financial sector is currently taking under that perspective of risks. And this brings me to the second example I want to bring with regard to the socio-ecological transition, as it was called previously, and which has been come into doubt that is actually something that governments are currently such stringently following. So I briefly introduced a definition to you before explaining why here again understanding how the financial sector currently decides is important. So bankability can be understood as a greater expected profit than compared to the level of expected risk. And as I said, risk can be quite a big realm of things. Here in the so once again, so an investor, a financial investor makes an investment if the expected profit is higher than the expected level of risks. And this is kind of the core matrix with which financial actors currently decide. If we apply that to the investments into the economy, and we divide the economy into green investments on the one hand, into harmful, climate harmful activities on the other hand, we get this matrix. And then we have, when we look at the bankability of those investments on the left-hand side, and this shows us that currently a lot of investments that are green are in fact not yet bankable, and that is why they're not being financed. There are activities that may never be bankable, and that under the current conditions of private finance dominance may also or will not be financed. Then we have this gray area where we have very highly bankable investments. Those are like the biggest example is investments into fossil fuels that are very bankable, so they have a high profit and usually a quite low risks. And this is why the financial sector keeps investing into those sectors. This matrix then also allows us, though, to have a solution. So this is what already currently is taking place, and which is discussed under the so-called term of de-risking. So with regard to investments that are not yet bankable and green, and central banks and financial supervisors can de-risk those investments, or also governments. And on the other hand, they can re-risk, so they can increase the risk of those activities that are very bankable but harmful to the climate. So these are some of the current versions of the first. On the one hand, the way that the financial sector is operating through risk return, and then on the other hand, what can be done in a very a transition scenario as it was discussed in the past years. This is then also pointing very much to the limits of finance. And before I give over to Solveig, I will introduce you or present you two further one learning and another more grander perspective with regard to finance as a planning actor. So this is kind of like a preliminary for my part, a summary of things. So I've learned in my research that as I introduced it to you, and as a political project, I think that finance is quite hard actually to politicize. It is important to acknowledge that finance is always political. So as we saw in this pyramid or the triangle, you believe that something is very fixed, but in fact it is not. But the way that we're taking it for granted means, it's very strongly institutionalized, so it's very hard to politicize. And then politicization of finance is usually not really done by social movements, but something that rather occurs through great crisis, or if you very much at the lower end of the hierarchy in the monetary system, then you have crisis like on a daily basis, and it's also hard to politicize. This is a bit of a word to caution, but this is also to say that it is not impossible, but that is quite hard. And then two other learnings I would say is that banks and finance are already quite unpopular. So this is something that you find after the financial crisis, but also when it was about the role of banks in the green transition or prospective green transition, is that you have quite of an or you have a sentiment that rather goes against banks and finance. But this is also a bit of a call to caution because sometimes it's not the, let's say, the fault of the financial sector on its own, but it's the fault of capitalism. So it's also the fault of the productive economy staying invested in certain areas, and it's a bit, and it's important, I think, to know that when you want to politicize finance, to also always draw the connection to the productive economy, that in the same way may move in the one direction or the other. And the last, what could help, what I think is, again, as we're doing it here, trying to understand a bit more what kind of the major tenets of finance are, so education, but then to also have this a radical plan ready for when a bout of politicization may take place. And what this kind of plan can look like, so Aaron Badanoff had recently published 2 articles in the New Left Review and in the podcast Future History. He has also sketched out a plan for a transformation. So actually the interesting part that how do you come from here to the desired future? And here, and I think that Aaron Badanoff will also publish that soon, but it's not written down in format, but currently only in this audio version. And here are some suggested rules that takes finance as a central node very seriously. And I think it's a very interesting and realistic approach to here politicizing finance. But once again, to state, it goes very much against the currently very established status quo of how finance is used. But he suggests capital controls to end central bank independence, to create money for public investments, and to also shrink the financial system. That is my part, actually, and I will hand over to Solveig.
Thank you, Janina. So now we're kind of moving more into the part of some maybe real-world examples where democratizing investment, socializing investment is already happening, and or things we could initiate as a movement again. And while what Janina said before is kind of focusing on the top of the pyramid of central banking regulations, credit regulations, the two measures I will talk about, democratizing public banks and creating democratizing public social funds, focus more on the second tier, so the banking system, and the private system. So they kind of target. The first one targets is a similar form of investment as investment given out by as credits by banks. But of course, you also have forms of investment such as just state expenditures, which we don't talk about here, but briefly mentioned in the summary, and then also investments by firms, which kind of the creating of public social funds targets. And then, so I will first discuss these two measures, and then in the end, just briefly mention two of the models in the democratic economic planning debate, which kind of propose a model for democratizing, socializing investment. So yeah, starting with democratizing public banks. So before we start to talk about, okay, how can we democratize them, it's, I think, important to define what public banks are or what we can understand as public banks. And here I follow Thomas Marois' definition of public banks as institutions that operate in the public sector. So they're either public entities in state ownership, municipal ownership, or act under a public mandate. Second, they perform some form of financial intermediation or banking functions. Third, I wanted to make some additions to the slides, but I couldn't anymore. So third, he says it's important that they are like enduring institutions. And the fifth principle, and that's very important to stress, is that they can either operate in the public or private interest. And what Marois often underscores is that they very much often act rather in private interest. As other banks, they have to capitalize on the free capital market, even though often they're state-backed. They follow the same banking logics Janina discussed. Often have mainly invest with the aim of profitability, of bankability, and also only that they are in public ownership doesn't mean that they're less likely to engage in risky financial schemes. So, for example, some of the popular German public banks, the Landesbanken, had to be bailed out because they were heavily invested in mortgage-backed securities during the financial crisis. So, yeah, even though they're public, it doesn't mean they're naturally good or institutions working in the public interest. Marois says there are approximately 900 public banks worldwide with a total assets of 57 trillion US dollars, which is quite a huge amount of money, and would be maybe good to there's a lot of potential for these assets. There are assets which can be potentially democratized. Yeah, and maybe it's of interest to you. There are such things as the European Association of Public Banks, which currently has 28 members, but there's also the German Public Banking Alliance, which has 64 members across the DACH region. So there are already institutions in place which could also be approached with organizing, umbrella organizations which organize public banks. Next slide, please. So even though public banks often don't naturally act in public interest, they are of course examples of public banks which do have follow a certain public mandate and do fulfill their public purposes. And as you can see here in this graph, which I took from a study by Urch et al., with which Janina also co-authored, they have a higher share than private enterprises. For example, in such a realm as global climate finance. So over 18% of all global climate finance in 2022 was undertaken by national development banks, public national development banks. And the key point here is that Marois says the public banks are already, as there are public institutions, they have potential to be held accountable and managed according to democratic standards wherever and whenever society demands it. So as they often have public mandates and do follow public purposes, there can be this possibility to democratize them and have them hold them more accountable towards social goals. And he says that one option to do this is, for example, to actively pursue public-public cooperations, so cooperations between public banks and, for example, public companies or public institutions such as local governments, to then follow democratically decided issues. And I wanted to give you an example of maybe the most democratic, thanks. Maybe the most democratic public bank globally. So this is the Banco Popular de Desarrollo Comunal in Costa Rica, which was established in 1969. It is a universal bank. So it does both commercial banking and development banking, investing in infrastructure. It's 100% owned by workers in Costa Rica. So it's not state-owned, but it's based in its statutes and in law that it should be owned by the workers. And its highest governing body is a democratically elected workers' council with 290 representatives. And this workers' council, then elects a management board, which consists of 4 worker representatives and 3 government representatives. Its total assets are 4.5 million as of 2016, which makes it one of Costa Rica's biggest banks. And its main purpose is to lend to the public sector. It heavily is engaged in financing social housing and infrastructure projects in Costa Rica. And it's also a very popular commercial bank. And I also found it very interesting how this bank is capitalized. So there's a legally mandated contributions, both from employer and employee side. So 0.5% employer contributions of monthly wages go into the bank. Similarly, 1% of the monthly wages of every worker in Costa Rica goes to the bank. And 1.25% of this 1.25% of these transfers go directly into pension funds after 1 year of the workers, and 0.25% stay with the bank as capitalization. Right? And that's, I think, it's legally mandated, and it's a very interesting model. And it similarly works, for example, for the labor. It's the Chamber of Labor in Austria, just as an interesting side note. Then I also brought a second example here. This is not an established bank yet, but it's a very interesting social movement, which is currently gaining strength and impact in the US. It's the California Public Banking Alliance. This alliance was created was initiated or inspired by this Standing Rock activism, which was kind of activists rallying against investment by big financial actors, and they wanted to create. And this alliance was inspired by these protests, and they want to kind of develop a counterforce to these big financial actors such as BlackRock. So it's social movements based, but they've had huge successes so far. They initiated the issuance of the Public Banking Act in 2022, which was passed in California. So now there's the opportunity to create new public banks, and these are at the moment in the works in San Francisco, Los Angeles, Sacramento, the East Bay, and the Central Coast. These banks should also be universal banks, which do both commercial banking and development banking. The ownership should be fully public and affiliated with the local governments, and the governing body should be democratic councils. And one of the scholars, or one of the models I will discuss later, Michael McCarthy, I think he's also actively involved with this movement. So his model is supposed to be inform the institutional setup of these banks, likely. And the objectives of this movement is to create public banks in all these municipalities to support social and environmental projects, so financing for infrastructure projects, but also to increase access to banking services for low-income households. So while democratizing public banks, for example, through more democratic governing and other capitalization, is kind of more directed towards investment made by banks, and maybe a little bit of a lower threshold. I now want to move to a second measure, which is maybe you could say higher up on the likely to be met with resistance ladder, public social funds. So this was a very popular idea discussed in the 1960s and 70s. The basic idea of public social funds, or workers' funds, they're also sometimes called, is to transfer in a certain amount of surplus profits or profits from companies to public funds. These funds should be managed and should be owned and managed by workers or otherwise publicly managed or in public ownership. The transfer of profits usually should take the form of issuing company shares so as to not jeopardize the company liquidity, and also to increase the co-determination of workers in companies. And the goals of these people who thought up these public fund schemes were to create long-term change and ownership of the means of production in favor of workers and the public, empowerment of workers in corporate governance, and democratizing investment decisions, where resources are dispensed in the economy and in society at large. And it was generally and openly considered a transitional measure towards socialism, and also discussed as such. And now I want to just give two examples of where these of two plans where these public social funds were thought up. The first is, and I think the most popular one, is the Meitner plan, which was developed by Rudolf Meitner in Sweden, a Swedish economist, also a member of the government. So the background of the Meitner plan is that in Sweden in the 1960s and 70s, we have like a social democrat government, and they follow the so-called Rehn-Meitner economic policy, which meant they followed an economic politics which combined Keynesian fiscal policies with centralized collective bargaining. You had very strong labor unions, like I think almost 80% of all workers in Sweden were organized in trades unions. They targeted low inflation, so implemented low inflation policies, and had a solidarity wages policy or scheme. And but due to this solidarity-based wage system, which means that there was a law saying that no matter in which company you work, if you work in the same field, every worker should earn the same, and that was supposed to create equality among workers, but it kind of led to a problem that very productive firms made excessive profits because they didn't have to pay their workers more. It wasn't attached to the profits of a company. This Swedish government saw these excess profits as a problem, and then told Rudolf Meitner to develop a plan, and the Meitner Group was established in 1973. And within 3 years, they came up with a very ambitious, comprehensive proposal, which we now know as the Meitner Plan. And the goal was to democratize corporate ownership and strengthen workers' leverage, and securing public control over these excess profits and over investment in general in the long term. And they proposed that 20% of annual profits in the form of voting shares should be issued by large companies, so they defined large companies as having 50 or more workers, and these should be transferred to workers' funds. And these workers' funds should be union controlled and managed by union representatives. There were supposed to be multiple funds covering all different kinds of sectors. And the ultimate goal was that after 20 or 40 years of where you would always issue 20% of annual profit as company shares, that the companies would eventually go over into the ownership of workers in Sweden. But yeah, the ruling party, the Social Democrats, accepted this plan and wanted to pass it, but they were not re-elected. And yeah, then when they came into power in the 80s again, a very watered down version of this plan was implemented, but it didn't had any of this original of, yeah, I think Rudolf Meitner himself said it's kind of only a shadow of what they've mentioned. And another important issue, which Janina also already mentioned before, which Neil Warner, who wrote his dissertation on the Meitner Plan and different other social democrat schemes for increasing social investment workers' funds, said is that one of the reasons it also failed was that political mobilization for these actions was much stronger on the capital side. So they really strongly mobilized against it, whereas workers didn't think it was central for achieving their interests. So I also brought you this overview of the institutional setup, how they envisioned it, but I think because of time reasons will not go into detail, so we can skip over this. And also here's the German equivalent example, the Gleitzop plan, which was actually developed before the Meitner plan, which I found very interesting. I didn't know about this. It was developed by Bruno Gleitze, an economist and SPD politician. And he formulated a plan which was later then kind of based on his plans, was a provision was adopted by the German workers trades union, the DGB, and but it also never came into, and it was never established. But we can also skip this. So now coming to an end, or like to the last part where, so I think democratizing public banks and like mobilizing for the creation of public funds are two very feasible measures which can be instigated in the current economic system we have. But then in the democratic economic planning debate, there are also elaborate models being developed for how we can socialize investment at like national or supranational scale, mostly national scale. So one of the models, which is very popular in the debate, is by Michael McCarthy. He has this model for democratic financial institutions, and he envisions these institutions to be implemented at national, subnational, and regional level. So it's kind of more a model for a democratic bank, but which could be also used for a national investment council. The model characteristics are that the model works a lot on lotocracy. So at the heart of each institution, you have the People's Assembly. People are similar to the US jury system, brought to this institution by lot. He also says that affected interests are an important principle that should be recognized in agonism of subsidiarity. And I just recommend you to read into his book where he describes this model in detail. It doesn't have a plan for capitalization, but I think this is where this, for example, such a model as the Banco Popular in Costa Rica could be an inspiration. And this is likely to inform the setup of the California public banks. And then the next model, which has gotten a lot of recognition in the last time, and Janina already discussed it, is Aaron Benanev's model of a multi-criteria economy. He sketches out the full model of this multi-criteria economy in the second article he published in the New Left Review. So if you're interested in that, check it out. So in the basic concept or idea of his democratic economic planning model of a multi-criteria economy is that all of society's investment should be decided on democratically. And investment is here not understood as financial investment for profit, but just as decisions between alternative future scenarios based on multiple non-reducible criteria. And he says, in the current economy, all financial decisions or all economic decisions are mainly reducible at some point to this issue of profitability or mediated by profitability. But in a democratically planned economy, you should take the non-reducible the non-reducible quality of different aims such as sustainability, social provision, aesthetics seriously. And from this, he kind of then argues this is why we need democratic deliberation, because if you have non-reducible criteria, you kind of have like a rational or like a calculated end towards which you can optimize, but you always have to decide between conflicting criteria. So just running through the different characteristics. Capital accumulation, wage labor are abolished in this model, so it's kind of very futuristic or like very utopian. There should be a universal basic income and universal public services. He also says in his model there's a dual digital currency system, so you don't have money anymore, but you have credits which can be used for individual consumption, and which each person has a certain amount of, based on also the labor they do. And then there's also points for companies and for transactions between organizations and for investments. And this dual digital currency system is very important he says, for breaking the circle between capital accumulation and the exploitation of labor. So in such a currency system, it's basically not possible anymore. Then he also says that an important feature is the national data matrix, where all the records of the flows and points are recorded. And then you can, based on this recording, you can then draw up plans for disposal of points which are used for deciding investment. And you have investment. The investment decisions are taken at 3 different levels. You have like companies can within their own production can make their own small investment decisions, but they are allocated certain points by sectoral investment committees, which are where you have representatives of different factories, of the technical associations which replace workers' unions in his model, of certain technical experts and consumer representatives. And then there are also, he calls them cross-sectoral project investment boards, which are then kind of tasked with larger, broader economic decision-making and project coordination. And this could, for example, he gives the example of a decarbonization project coordination committee. Okay, I know this is kind of a lot, but I just wanted to give you an idea of what's out there, and we can talk about it later. So now I think we're coming to an end. Yes. The summary of the overview of the measures of investment socialization. So, and Janina, just jump in if you want to say something. So the first is kind of what Janina said already: abolition of central bank independence, introduction of more democratic oversight in the institutions we've already have, more democratic accountability, and that this is already possible. That it's possible to override this principle is actually very nicely shown by the Trump administration at the moment. It was just from the wrong side. Then the democratization of public banks, as I've discussed. And then one measure which we haven't really discussed, but which Cédric Durand always mentions, and I think is really also important to note, is the expansion of public services is the socialization of investment in itself. And the extension of the amount state expenditures is paid for social purposes. Then you have public-public partnerships, which can be drawn up by public banks and public projects for public purposes. The introduction of comprehensive capital controls, introduction of wealth tax. Benenef says this is not a measure in itself, for example, for creating investment funds. It could be also in this model. It's not. It's just to redirect power or to rebalance power. But of course, wealth taxation is also if it's then used for example, spending on public purposes, can be a measure for socializing investment. And then gradual expansion, like setting up and expansion of investment planning institutions, such as those discussed by McCarthy or proposed by Aaron Belendav. And then maybe the final step would then also to take a global perspective. This is rarely discussed in the democratic economic planning debate yet, how investment socialization or could work also on a global level. But yeah, maybe something for a future discussion.
Okay, thanks a lot.